So without further delay, let's jump straight to that point, hypnosis. So imagine yourself waking up early in the morning. The first thing that you do, of course, you check your mobile phone and see if there are new messages. And indeed, there are. Someone is enjoying early morning. Someone is celebrating his birthday. Someone is complaining that his credit card got denied. You think to yourself, oh, that poor guy. As a day passes, you arrive to your work and you learn that it wasn't that just poor guy. It is actually a whole payment system that got failed, and not just one system, but all of them. Everyone is writing about that. There are protests and people complaining that they cannot live without credit cards and payment systems. As a day passes, there are debates. Nothing unusual for our society, right? Just to be on the safe side, what you do, you check if you have enough cash in your wallet. A month passes, nothing much changes. You use more of ATMs. There are more security vans in the streets. Of course, there are more robberies since money tends to attract people, right? As security vans got robbed, some funds may not reach good producers, therefore there are ships stuck in the ports since we cannot leave if so receiver hasn't paid for these goods. Of course, in the result, there are less options in the shelves, and those that are there may be not that fresh, but as one person might say, things are not great and not terrible. Yeah. 3 to 1, you are back in the room. So thankfully that was just my imagination that plays tricks with you. But hopefully this give you an idea why we need payment systems in the first place. And payments are basically enabling economies. And to be honest, we take it very seriously. So that was the part explaining why do we need payments in the first place. Now the boring part, how. I'll start with a very simple model. It's called four-corner model, where we have a debtor, let's say me, and a creditor who is willing to receive funds. It can be any person. Then in the bottom we have a debtor bank and a creditor bank, which basically enables that credit transfer. And in the center there's a CSM, basically allowing banks to communicate with each other and to transfer those funds. I'll come back to it in a minute. The nice thing about this four-corner model is that it can be actually expanded in different ways. So we can take a customer, a debtor, and that customer might be a private customer, it might be a business customer. If it's a private customer and we are, or he is willing to transfer or make a simple credit transfer, he might want to use a mobile phone, he might want to use a laptop, or he might even want to pay a bill via some third-party company like postal service. If it is a business, let's say a Starbucks, that business might operate multiple branches in different countries, right? And we might want to track how those branches are performing, what are the balances within accounts. Or it might be, for example, some institution willing to pay pensions or social benefits. So we have different customers, and these customers have their own needs. And here, fun fact, it's actually possible to make a payment without knowing credit or account number. A bit of context here, there's a standard called ISO 222. It actually defines multiple areas like payments, currency exchanges, etc. Among those things, what it defines, it tells or suggests what messages should be exchanged between the customer and the bank, and the banks themselves. And one of the messages is customer credit transfer initiation. And within this message, we can see that creditor and creditor account is optional. And this puzzled actually us for a bit, how it can be that someone is willing to transfer funds without knowing to where those funds should land. And as it turns out, particularly in US, there's a service where creditor bank which receives funds, instead of debiting those funds into a customer account, can issue a check, and that check might be delivered via postal services to creditors' home address. So therefore, some payments might not have a creditor account number or receiver account number. Yeah. If we would go back to four-corner model, we could try to see what it means for a bank. So we discussed that there might be different customers. It might be necessary to support not just payment initiation, but notifications about payments that took place, right? On our side, we have a CSM, and same bank cannot be just creditors or debtors bank. It has to support both, actually, outgoing payments and incoming payments. On top of this, banks are not just monoliths. Within a bank, we can find different systems that are responsible for different things. One system might be responsible for savings account, another one, for example, for loan account. Third system might be screening payments for fraud, sanctions, etc. And even if we would dig a bit deeper and would look into the technologies that are inside the bank, probably I would be wrong to say that you can find any technology within the bank. But it's pretty much close to that. Even the fact that the next talk is about AI shows that, at least Danske Bank is innovating in technologies. Yeah. Next thing in this four-corner model is CSM. So as I mentioned previously, it basically enables banks to talk to each other and exchange payments between the banks. A bit of history, how it all started. At first, banks was just huge vaults where someone willing may deposit gold bars or funds, and probably one of the banks thought that we might provide additional service to his customers. And what the service allowed to do a debtor, a payer, instead of transferring or bringing funds directly to funds receiver, could issue a check. Initially, those cheques were just simple handwritten notes. In later stages, these notes evolved in more formal documents, which we know now as cheques. But basically, these cheques allowed debtor, without going to bank, to transfer funds to a creditor. And of course, there were horses traveling back and forth between the banks and transferring those cheques and gold bars. As more banks joined this service, it became hard to manage it and maintain it. Therefore, and this way, first CSM has born. Initially, it was just a random place. It could have been open field or even a stable where representatives from each bank gathered at agreed time and exchanged both cheques and gold bars. But there were some issues with this model. Since banks had to carry gold bars or coins to that location, some banks were robbed on the way to it. And this way, CSM actually evolved into a bank of banks, where each bank could open his own account or a vault, maintain their gold bars, and it was no longer necessary with during each exchange of cheques to transfer also gold bars. And this decreased the risk of being robbed. As technologies progressed, even the cheques got replaced by electronic messages. And of course, technologies even changed the way banks interact with customers. Now, debtor can go into his mobile phone and tell directly to his own bank that he wants to transfer funds to some party. Also, technologies allowed to get rid of the need to make gold movements between CSMs and the banks themselves. Instead, what we have now, there are money markets where banks might borrow funds or do deposits. There are currency exchanges where banks might sell some currencies and in exchange get other currencies. Or same CSM might be credited from our CSMs. And CSMs themselves actually evolved. They got split into two. The first is ACH, that's a clearinghouse, which basically enables to exchange messages between the banks, and RTGS systems or settlement systems where banks actually keep their money. So what happens that clearinghouses calculates the bank's positions, and as money moves between the bank, those movements are then settled in RTGS systems. Actually, this model didn't quite eliminate the need for cheques, and there are still banks which operate with cheques. And this was particularly visible during 9/11 events in the US, when planes got grounded for a few days, and during the same time it wasn't possible to clear the cheques between the banks. since at that time checks were carried over the planes. And although central banks doesn't quite agree with that, but there are experts saying that this even further accelerated the digitalization of banking industry. Yeah, and of course it would be too easy if there would be a single clearinghouse or a single TGS system. What we have instead, we are multiple RTGS systems which allow you to settle the funds and multiple clearinghouses. The way it works, it starts from payment councils or organizations. Those organizations might be a joint effort of a bank, or it might be a branch of a central bank, which then define clearing schemes. Clearing scheme is basically a rule book or a document stating what messages can be exchanged between the banks, and also states additional rules. When those clearing schemes are implemented by the clearing houses. And a single clearing scheme might be implemented by multiple clearing houses, or there might be even same payment council or organization which defines a clearing scheme which also implements it. In parallel, we have central banks. Central banks basically are responsible for national currencies. There are such central banks like Denmark's National Bank, European Central Bank, etc. Those central banks are responsible for operating RTGS systems that allow to settle the funds. And clearinghouses and settlement systems then are connected via networks. Most known probably network is SWIFT, but along it there are additional networks like CNET, even private networks, etc. And recently there were talks, what does it mean for a bank to lose access to a SWIFT, right? So it actually depends on clearing systems and settlement systems, how or what connections do we allow. There are clearing systems that allow just SWIFT, or we may allow multiple networks. So it depends, in short. Okay. And next part is about international payments. So it's easy when you are making a credit transfer within a country. But what if someone from, let's say, Denmark wants to make a credit transfer to United States? And for example, Danske Bank doesn't operate in the United States, right? What about Chile or China? It's probably impossible for a single bank to operate in all countries. And what happens when there is no such thing as a global clearinghouse or a global settlement system? And as we talked, SWIFT is just a network. It doesn't allow to actually move funds. And here is where correspondent banking comes into play. It's basically a same picture that we saw previously for corner model, just that in the middle we have additional party called correspondent bank. And the way it works, for a debtor which initiates a credit transfer, it looks like any other credit transfer. He simply submits that credit transfer to his own bank, right? And then it's bank responsibility to make the funds move to creditor which resides in another country. And how it works, that debtor bank then issues a message via usually SWIFT to that correspondent bank which operates in the same country as creditor is. And then that correspondent bank is responsible for making a funds transfer to final receiver creditor. But there's a challenge. We cannot tell anyone or our bank to make a credit transfer to anyone, right? That would be unfair. It would be equal as me saying to you, could you give someone else funds? And the way it works, actually, that prior making credit transfers, debtor bank has to open account in correspondent bank and pre-fund that account via same mechanism as we discussed previously, either money market or currency exchanges. But there are risks associated with this model. What if a correspondent bank goes bankrupt, or someone decides to freeze debtor's account in correspondent bank? That is liquidity risk. That basically debtor bank might lose his assets or funds in that correspondent bank. And of course, there are additional risks that like operational risk, reputation risk. Another thing is that, or another challenge actually, is that debtor bank is not directly connected to CSM, right? And he might not know the rules that CSM enforces. For example, local CSM in USA might operate with sort codes, and those sort codes might be necessary to make a funds move. And debtor bank might not know this. And what happens here, that such payments might require manual handling, meaning that there is a person sitting in correspondent bank and manually adding additional values or adjusting the payments before that payment gets moved to creditor. And that's where the additional charges come. It might seem from debtor's perspective that it's a simple credit transfer, but that credit transfer might require manual handling. Yeah. And here I have some statistics of Target 2 settlement system. It's a main system in European market. Here, what we can see is the number of participants. That is the number of the banks who joined it. Daily averages of the funds transferred. So we can see that each day almost 2 billion euros are moved within the system, and the average transaction value is 5 million. Yeah, so it was a bit of a journey. I tried to cover different aspects, how payments are moved. But honestly saying, I mainly focused on credit transfers, and payment domain actually consists of more functionality like recalls, fees, screening, etc. And that might be a good topics for next talks. Yeah, credits. Firstly, I would like to thank you for a person who thought that CSMs might be a good thing. Of course, our colleagues and Mindaugas, who is in the background. Sylvia for organizing this Danske Bank Tech Night, and for her colleagues as well. And of course, you for giving me the privilege. And as always, there are additional sources if you would like to get more details.